Hi, everyone. Ryan Detrick here. Welcome to the LPL Research Midyear Outlook 2020, The Trail to Recovery. What a year 2020 has been so far. You think about it, we just had one of the worst recessions we've ever seen since the Great Depression. The good news is this might be one of the shortest recessions we've ever seen also, though. Taking a look at stocks for a second. The first quarter was the worst quarter for stocks, looking at the S&P 500 in history. Then we come back in the second quarter with the best quarter for stocks since 1938. There's a lot to discuss about what we just saw, but we've even got more to talk about here the next 25 minutes or so. We're going to look at the economy, stocks, bonds, and the election. Should be a lot of fun. But I want to bring in my good friend, Jeff Buchbinder. Jeff, at this point, what are some of the main takeaways you think from the first half of this year, what investors can learn from as we head into the second half of 2020?
Well, first of all, on the economy, tremendous resilience, snapping back after one of the sharpest economic contractions we've ever seen, right? We've gotten basically a V-shaped recovery to this point, really a remarkable comeback for the economy. And on the stock market, I mean, you said it, Ryan, if we end up the year positive, and we were pretty close at the halfway point, we're already there now as we're recording this, would be the biggest comeback in the history of the S&P 500. After being down 30%, we've got a shot at an up year. It's really remarkable.
No, it absolutely is. So, Jeff, I mean, let's just kind of get right into things and take a look at the economy. Like you just said, let's lay the foundation here. The idea that we just had a 10.5-year cycle of growth came to a screeching halt. We've said it before. How do you stop your car? Pump the brakes, slam on the brakes, hit a tree. The sad truth of the matter is when the government told people to stay inside, they knew that that was like hitting a tree. And our economy, which was moving along pretty good, I mean, we had a really weak weak-ish fourth quarter for global growth. Early in 2020, the global economy was really turning around. And then obviously once March hit, that's when the recession officially started, ending the record 128-month in a row expansion. Now, Jeff, you know, bigger picture with the economy, you kind of hinted at it with this V recovery versus a W recovery. Everyone likes to say, what's the shape of the recovery? And it's you know, you can talk to 10 economists and get 10 answers. What is your take? What's the shape of this economic recovery that we're looking at the second half of this year?
Well, Ryan, we went with the swoosh,
Right.
sort of a pretty quick decline and then a somewhat of a gradual recovery. Now, we already got the first part of a V, but from here, we think we're going to have more gradual trajectory of economic recovery. We got the low-hanging fruit, and the next leg of this economic recovery with social distancing and changes in consumer behavior, we think is going to be tougher.
Yeah, you mentioned the initial surge off of those lows. And just before we recorded this, we saw a record number of increases in existing existing home sales, up like over 20%. We've seen record numbers of jumps from manufacturing and retail sales, and just a lot of positive things. But Jeff, you know, that's the catch, right? That initial part's early. I mean, why? Some people say there's going to be a V. Why are we saying swoosh? Why is that last part of the recovery going to take a little bit longer than maybe some people expect, you think?
Well, part of the reason is because the stimulus is going to eventually run out. And another part of it is, you know, we still have unemployment over 11%
Right.
in the U.S. A lot of people certainly are out of work. The stimulus has certainly helped support spending over the last several months as we've been fighting this COVID-19 pandemic. If we look out several months, we've unfortunately probably going to see that the next leg of this recovery is going to be a little bit tougher, as some of those effects are going to be delayed. You know, we'll see them probably later this year.
Yeah, you know, I talk about it like when you move. We moved to Charlotte about 4 years ago, and in our garage, we've got like 4 big boxes at the top of the garage. I have no idea what's in there, right? You move and you move all your stuff in, and it's like that final part, the final thing takes longer than you expect to finally move or finally unload it or, you know, move out. And my wife and I joke, it's like, well, I guess we'll find out what's in there next time we move. And you think about the economy, you know, we've had parts come back. I mean, retail sales is like 1% away from the peak it had back in February. That's amazing. But other parts of the economy are going to take years to come back. I mean, think about this. When you look at jobs, we know we've lost, you know, tens of millions of jobs during this recession. Now they're coming back fast, but still looking at the previous two recessions after the tech bubble recession took 4 years for jobs to fully come back and over 6 years for jobs to fully come back during the great financial crisis. So there's a lot of reasons to think it's going to take a while for this economy. It's bounced back, but it's going to take a little bit of time to finally get there. Now, Jeff, let's talk about earnings. I mean, let's talk about GDP here. You know, you think about the economy, we're looking at some of the worst numbers we've ever seen in the second quarter, looking at GDP maybe down 30%, but the second half, we might see some of the best numbers. It's all relative off those low numbers, but tell us a little about why GDP can bounce here.
Yeah, it's a year of superlatives
Yes.
for sure. We're already seeing it. I mean, you mentioned retail sales. We look at a lot of these measures of real-time economic activity. You know, you can look at mobility data, you know, how many people are, you know, looking at GPS map requests, how many people are commuting, how many people are going through airports, you know, things like that. They're all showing that we've had this really strong bounce off the bottom. It really started at the end of the second quarter, but it's going to continue in the third quarter. So, you know, expectations for the second half economic recovery actually might be a little bit too low, depending on how this plays out. You know, the U.S. consumer certainly has strong willingness to spend, and certainly we all want to get this economy reopened. That's happening, and will probably continue to happen, even though we have had to pull back on reopening plans in some of the areas in the country where we have some COVID-19 hotspots.
Yeah, let's take a look maybe at some of the global forecasts here. So here are some of our forecasts that we see on our base case. You know, we think U.S. GDP could be down between 3 and 5%. Developed ex-US, that's Europe. We still see some structural problems with Europe. We think a little weaker growth there. Now, Jeff, one area we do like on developed international is Japan. Tell me a little bit about Japan and why we think that could be kind of a wild card, or maybe even a surprising to the upside, whether it be stocks or the economy the second half of this year in Japan.
It's all about stimulus, Ryan. Japan, when you combine what the government's done with what the Bank of Japan's done, they've actually added stimulus in the amount of about 40% of their gross domestic product, of the entire size of the economy. That's quite a bit more than what we've done here in the US with our federal government and the Federal Reserve. Massive, massive stimulus. Consensus expectations are for Japan's economy to hold up a little bit better than the US this year, and Europe. And certainly we wouldn't be too surprised based on that stimulus if they do even a little bit better than currently reflected in economists' forecasts.
Yeah, and then you turn to emerging markets. I mean, this is probably a little surprising, but emerging markets should do better than the U.S. and then developed ex-U.S. You think about emerging markets. We just saw data out of China. We got positive GDP growth in the second quarter. We already said U.S. GDP growth could be down as much as 30%. Now, China is obviously a couple quarters ahead of us as we go into the fight of COVID-19. But emerging markets are an interesting area because if you look, you have to slice it a little bit. The Asian emerging markets are the ones that we think we're more bullish on going forward versus some of the Central American and South American markets, which have been devastated by COVID-19, are still a little on the weak side. And all in all, for the global economy, this will be one of the few years potentially we've ever seen in history that'll likely have negative GDP growth. So, Jeff, you are the equity strategist on the team. The stock market, let's move ahead here. And you can see we say gains ahead, but with some bumps along the way. And that's, like I said, as we record this, S&P is like up, about 1% for the year. Oh my, there have been some bumps along the way. Actually, let's leave it here for a second. Tell us about why the stock market might have a little trouble going higher the rest of this year. Or not trouble, but, it'll be a little troublesome to gain from here after those massive gains we saw.
Yeah, maybe we shouldn't be saying bumps on the way. We should be saying rapids, given.
Yeah, I think I've got a welt on my head, I think, from what happened in March.
Yes, for sure. So we'll see some choppy waters most likely as we continue this really tough battle against the virus. But we still see upside for stocks. We talked about how we've seen evidence of a really strong economic recovery off the bottom. We've also seen signs that earnings will recover pretty sharply. And if you look out to next year, where we certainly hope and pray that the battle against COVID will be over, we think we can get back to previous pre-pandemic highs of both earnings and economic activity at some point, probably back half of 2021. Maybe it takes a little into 2022. But for long-term investors, we think stocks look really good here, even though maybe in the near term, they may be pricing in a bit too much optimism in our view about the recovery.
Yeah, you think about that recovery. The S&P is up like 45% from the March 23rd lows. NASDAQ technology obviously up even more. So truly a historic move. But the thing I think that's important, as the next slide shows here, is bear market recoveries normally, now this isn't a normal year, normally can take years potentially before you get back to new highs. Now, honestly, who knows? I mean, the S&P's gained almost 5% in July. It gains another 5% next month. It does, we're at new highs. That'd be one of the quickest recoveries ever. But I think the important takeaway on this next slide is when you look at the 34% correction bear market that we just had, this is a record bounce. We just had one of the best 50-day rallies in stock market history. In the second quarter, when stocks gained 20%, that was one of the best quarters we've ever seen. When I took a look, Jeff, and found previous quarters that gained 15%, only been 8 of them back to World War II. That next quarter was higher, take a guess, 8 out of 8 times. 2 quarters later, higher, 8 out of 8 times. I think the key thing that I want to stress is this incredible strength that we've seen the last couple of months off those lows is the hallmark, and this sounds crazy, the hallmark of the beginning of a new bull market, not the end of a bear market, not a bear market rally, not the end of a bull market, but this much strength historically suggests potentially stronger gains out into the future, 6 to 12 to 18 months later. But the key point being, it could be a little troublesome in the near term as we kind of digest those gains. Now, Jeff, I'll go to you. You mentioned earnings. This next slide takes a look at earnings per share declines during recessions. This actually looks like an average decline, right? What do you see here?
It could even be a little less than average based on what we're seeing so far during the second quarter earnings season. I think it's important to draw a comparison to 2008 and 9, the great financial crisis. It looks like this recession will be much, much shorter, and even though it was deeper. And it also looks like the bear market recovery will be much quicker, and certainly earnings will support this. A lot of folks think that stocks have gotten expensive here. Certainly the NASDAQ in particular, a lot of people are talking about how that rally may have gone too far. But if you just assume that earnings can get back to normal in 12 to 24 months, it's actually pretty easy to justify stocks going a little bit higher from here, especially given that interest rates are so low. Remember, it's about stocks versus bonds. PE ratios, price to earnings ratios, reflect interest rate levels. We think stocks can go a little bit higher, even though there's a lot of uncertainty in the near term.
Absolutely. We're going to talk more about interest rates and inflation here in the next segment when we talk about bonds, but inflation is virtually non-existent as well. And every time I hear average, and you look at that, I believe there's, what is it, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, I believe 13 recessions since World War II, if my math is right on the screen. It always reminds me of the statistician who, when he stuck his head in the oven and his feet in a bucket of ice, they said, "How do you feel?" He said, "Well, on average, I feel pretty good." So even though this is average, this one doesn't feel like average. This recession, this bear market we felt doesn't feel average. But when you look at the earnings, it actually is more average. So let's kind of wrap things up here, Jeff. Then we're going to get moving and talk about fixed income and then finish things talking about the election. This year is so uncertain. With COVID-19 and every day it feels like we come into positive news on the vaccine front, positive news on a therapeutic front, but we're still a long way away from getting to beating this terrible virus. But that's why we made a bull case, a base case, and a bear case. And you can see on the screen here, we're right about our base case, right? 3,250 to 3,300 or so is our base case. Maybe a little more upside could be in play here. Earnings, like you said, such an important factor. If we get some more normalcy, we're in the heart of earnings season. It's going to be so important to see what companies say about the future. And last quarter, we had a record number of companies that didn't even want to give guidance about the future because they didn't know what was going to happen. No one knows what's going to happen in the future, but it was so uncertain this year. And then the 10-year yield, we're going to talk about that here in a second, but our base case is a little bit higher 10-year yield from where we are between 1 and 1.5%. So, Jeff, let's go to the bond market, talking about yields and maybe talk about the Fed a little bit. We say modestly rising, but depressed yields may leave investors with little return from bonds. One more slide here. This is the income component of the Barclays Ag. Jeff, tell me why we think yields are going to go up a little bit, but they're still going to stay pretty low historical here.
Well, first, I lobbied for this section to be called, bonds, the point of no return,
Yes.
for the, headline under that last image on the last side. I mean, it's pretty close to where we are. We're not looking for much in the second half from bonds. If you see a little bit of a tick higher in interest rates, and then you combine that with low yields, and that's what this chart shows, right? The Bloomberg Barclays aggregate, that's a measure of the broad bond market. We're not seeing a whole lot of yield. That's not a new story. It's been falling essentially for 4 decades. But you combine low yields and potentially rising rates. We haven't seen it yet, but we may begin to in the second half. That spells low returns for bond investors, but that doesn't mean don't own bonds. We like bonds as diversifiers in case the stock market volatility picks up in the second half.
Right. And what has the Fed said? We have a Fed chairperson, Jerome Powell, who's been on 60 Minutes 3 times the past year and a half. That's never happened before. He's been very upfront about what he needs to see. One of the key things he says he wants to see is inflation pick up before the Fed starts hiking rates, and maybe then you start to see rates go up in general. We're not seeing any inflation, right? Core CPI was just down 3 months in a row for the first time ever. Now, I'm aware we have a 100-year pandemic hitting us, and that probably played a big part of it. But for now, inflation still is very low, and that's one other reason, along with the fact that there's so much demand for U.S. debt, right? I mean, our 10-year yield around, I think, 60 or 70 basis points. That doesn't sound very high, but then you look around the world, and it is pretty high. So remember, it wasn't that long ago we heard about China was going to sell all of our treasuries and spike our yields. That hasn't happened at all. So you've got the global demand for it. You've got low inflation. A lot of it just makes sense for low yields. But again, as the economy picks up a little bit, we think it makes sense that we get a little bit of a spike here in 10-year yields by end of the year. But Jeff, the next slide shows just kind of what economists, according to Bloomberg, and according to this, there might not be a rate hike in 2020. There might not be a rate hike in 2021. So we might have low rates for a while. What are your thoughts on that?
Well, remember, Fed has this dual mandate, right? And it's about inflation and employment. We're at double-digit unemployment, even though that measure has improved. We've gotten a lot of jobs back after the initial shock of March and April, which is good, but a long way to go. A lot of healing left ahead of us. And the Fed is going to be very, very careful to ensure that the economy gets back to full employment before they start raising rates or meaningfully pulling back on all these bonds that they're purchasing. So, yeah, they're going to be on hold for probably the next couple of years and maybe even beyond. And the unemployment picture is really the key reason why. There'll be some folks lobbying for higher rates after we do hopefully get a vaccine and can get COVID-19 fully contained. But we think in the recovery, the Fed is going to be very careful.
Yeah, and remember the old saying, don't fight the Fed. On March 23rd is when the Fed came out and said they're going to start to buy a lot of different types of debt to kind of bring back confidence and liquidity. And March 23rd exactly is when the S&P 500 made its low and then started to soar higher. So just some big picture things. Now, Jeff, if you were an investor in fixed income, and we actually kind of skipped on if you're an investor of equity, so we'll do that next. If you're an investor in fixed income, if you think rates are going to go a little bit higher here, where would you think you should invest the next 6 months or so?
Yeah, we would be focused on the intermediate part of the curve, certainly with some short-term bonds mixed in. Be careful with the interest rate sensitivity that you get in long-dated bonds. So that's where we're focused in the portfolios that we manage. In terms of the various sectors, we've got a healthy mix of treasuries, corporates, and mortgage-backed securities, really diversifying across the high quality bond sectors, with in some places, where suitable, where we think it's appropriate, a little bit of high yield, a little bit of emerging market debt.
Yeah, exactly. I mean, I guess to put a bow on it, a little higher quality, maybe a little bit shorter duration is kind of how we think it plays out the second half of this year. And emerging market debt, I've been with LPL for 4 years now. As far as I know, we've never really been warm and fuzzy on that group. And again, that's an area that potentially you can find some diversification and a little bit of alpha. That's called outperformance in our geeky language for your bond portfolios. But Jeff, let's go talk about stocks because we didn't do that. And then we're going to get to the election. We think, the bull market's alive and there can be some more gains. but I'll take a few, then I'll go to you. We still like large caps over small caps. We still think, some of the cyclical names, the technology continues to look well. Healthcare continues to look really well. The communications group looks really strong here. Those are some of the names that have been leading for a while, but we really think they can keep going. Jeff, what are some other areas on the equity side of things that, for the second half of this year, we think people should be invested in?
Well, those are the areas, Ryan, that we think are best positioned for the pandemic environment. But looking out beyond the second half, where again, potentially this pandemic could be over, financials and industrials we think are well positioned for that recovery. And then, turning to regions, emerging markets, you mentioned that the economic growth outlook for emerging markets is certainly relatively strong. Emerging markets could actually grow this year, their GDP overall. That's mainly China, other parts of Southeast Asia, which we think should support better stock performance in the emerging markets, which still are very attractively valued in our opinion. So I think we hit on the major areas that we would be focused on here.
Absolutely. And then to kind of wrap it up, the whole growth versus value discussion. We do side a little bit with growth here the second half of this year, but like you said, on the value side of things, your financials and industrials, if you get the economy coming back, those are some areas that really could, as they say, take that baton and do well going forward. But bottom line, we still think stocks will probably outperform bonds the second half of 2020. And you cannot get through a presentation on 2020 without talking about the election. Stock market gains versus recession and COVID-19. Jeff, how about I'll take the first one, you can take the next one. Historically speaking, when you have a split Congress like we currently do, think about it like this. This is how our forefathers wanted it, right? Forefathers wanted it. Not too much power one way or the other. Tough to get one thing done. If you have all the power, it's easier to get something done. And look at the screen. When you have a split Congress, the S&P's gained almost 17% on average per year. In fact, it's been higher. The S&P's been higher the last 10 years that we've had a split Congress. Now the S&P, when it was down 34% this year, I didn't think that was going to be the case. This might be the 11th year that we've had, higher stocks with a split Congress. And as of this time, as we get into November, of course, the election we think is more of a coin toss, but we do still think at this time you're going to have a split Congress and all is said and done. So everyone has an opinion on who they want to win the presidency. But for your investments, it might actually make sense if you kind of side with having that split in Washington. So not too much power one way or the other. So Jeff, tell me, can stocks predict who's going to win this thing?
Stocks have a great record of predicting election outcomes, but it's not August yet.
Right.
That is a 3-month pre-election indicator. And so we don't really have any insight on that right yet. But once August starts, that's when you want to watch the S&P 500. If it goes up, good chance that an incumbent wins. So that would be President Trump. And of course, if the S&P goes down, good chance Biden wins. So we'll be watching the stock market really closely during that period. It's worked virtually every year over the last 30 or so years. And we think there's a good chance that works again. Correct me if I'm wrong, Ron. I think the stat is it's worked 87% of the time.
Yes, 20 out of 23 times if the stock market's up, the incumbent wins. Stock market down, the incumbent party loses. And it's been right every single time since 1984. Now, the fact that I've seen this more out there, maybe the market's priced it in, maybe it won't work this time, but it makes sense. You think about it, you kind of know what you have if the market thinks the incumbent president or incumbent party is going to win versus if you have that change in leadership. And think back to 2016. Virtually everyone thought Hillary Clinton was going to win except the stock market. The Dow had a 9-day losing streak directly ahead of the election. Copper, an industrial play, over President Trump infrastructure play, had a record 14-day win streak directly ahead of that election. So those are some things that I think a lot of people overlooked at the time. But as we get closer to this, LPL Research will be talking a lot about it. Kind of what are the markets telling us? And Jeff, maybe let's wrap it up like this, because everyone wants to know, where should I invest if President Trump wins? Where should I invest if Joe Biden wins? What's some sectors that might do well, nonetheless, who wins? It doesn't matter who wins. What do you think?
Yeah, we would say technology and healthcare still have significant tailwinds no matter who wins. You can get into the finer points of maybe China policy or tax policy, maybe talk yourself into a different view. We wouldn't do that. We would stick to what has secular growth tailwinds. That's certainly technology and the related technology areas in internet and healthcare as well.
Yeah, and I'll just add this. In 2016, when President Trump won, everyone said he was going to go after big technology names. Technology was going to be weak. Technology is weak for like 2 weeks. And now the last 4 years, technology has been the strongest group. Everyone thought that steel and coal would do very well under President Trump. Those groups have really struggled. So just because it's obvious and everyone's talking about it, that doesn't always mean it's going to happen. In fact, if everyone's talking about it, it might mean the opposite is going to happen. So just be very aware of that and have a long-term plan. Continue to work with your financial advisor, your financial professionals, follow the fundamentals, the valuations, and market technicals, and don't just blindly assume because there's one president in office, that's what means stocks are going to do this, or that just means bonds are going to do this, or the recession is going to happen. Take all those data points and try to detach yourself, I think, from your political lines with your investments. So, Jeff, we said we wanted to keep this under a half hour. We've got a couple more minutes. Any other things as you sign off here that people should be on the lookout for the rest of 2020?
Well, I want to make one more point on the election.
Yep.
Certainly what most people want to talk about that we kind of glossed over, right? We had a recession this year.
Yeah.
Historically, recessions drive change. And so, that's a hurdle for President Trump to overcome. However, we may see a real surge in economic activity over the next several months. So a lot can change between now and then. So we would also be careful. Don't just automatically assume we've got a Biden victory because the economy has entered a recession, probably coming out of it as we speak. There is a lot of time to go.
Absolutely. And I'll just sign off with this. Thank you for everyone who's listened to this year's video format of the Mid-Year Outlook from LPL Research. The continued drive of humanity and just the undenying strength that we have to fight this latest battle, this terrible battle. You don't bet against humans. Don't bet against mankind. There's going to be some positive drug results. I think one of the bigger where we could be surprised the second half of this year is maybe we get some good news and the economy keeps opening up and we can, maybe even have more equity gains and maybe get closer to that bull case that we laid out. So, the bottom line is LPL Research will be here for you. We greatly appreciate everyone, taking this ride with us the first half of this year, and let's hope the second half of this year is a little smoother and potentially just as lucrative as it's been the last couple of months. So with that, everyone, thank you very much. Thank you, Jeff, for being here. We're going to sign off, and please continue to follow us on Twitter at LPL Research. You can go to lplresearch.com to check out our blog. Jeff and I have a weekly podcast, LPL Market Signals, that you can listen to and play along every single week as we're talking about what's going on out there. So everybody take care and thank you for being here this week. Bye-bye.